Welcome to today's market report.
European shares dropped on Wednesday, snapping a three-day rally as investors tempered expectations of central banks toning down their hawkish stance on inflation, with declining business activity in the region, fueling fears of an economic downturn. After rallying more than 5% in the previous three sessions, the Pan-European Stoxx 600 index was down 1% as a sharp rate hike from New Zealand's central bank on Wednesday jolted investors and weighed on risk sentiment. The index had logged its best one-day performance since mid-March on Tuesday after weaker U.S. manufacturing data, shrinking U.S. job openings, and a smaller-than-expected rate hike from the Reserve Bank of Australia spurred hopes that central banks globally could shift to less aggressive rate hikes in future. Today is a realization that it's still too early to conclude the pivot is coming. Employment data from the United States on Wednesday did little to allay jitters about rate hikes. U.S. private employers stepped it up hiring in September, while the Institute for Supply Management Services Industry Employment gauge also shot up, suggesting strong labor demand. Investors are now waiting for a more comprehensive U.S. non-farm jobs report due on Friday for further clues on the state of the labor market and whether the Federal Reserve could pivot from its current ultra-hawkish approach. Meanwhile, the latest data showed Eurozone business activity contracted for a third month in September, dashing any hopes in the currency union will avoid recession. The Stoxx 600 index has fallen 18.2% so far this year, as the region grapples with an energy crisis exacerbated by the Russian-Ukraine conflict and concerns about an economic downturn with aggressive policy moves by the US Fed and other central banks. Nearly all Stoxx 600 sectoral indices fell, led by real estate stocks and retailers. The GBP/USD is trading at the lowest level in 2 days, around 112.30. Euro-dollar plunges from around parity to 0.9850.
This is today's market news. Thanks for listening. We'll see you next time.